Hello and welcome to the Weekend Investing Daily Bite of September 30th, last day of the month. And what an action-packed day it has been. Chinese markets zooming like never before. Japanese market cracking very hard on change of leadership. India market also cracking hard. Liquidity flows from FIIs seem to be going out as Chinese markets are attracting a lot of FII money right now in the last few days. Chinese markets are also at the cusp of a long holiday. So there is a huge rush for people to get into stocks before the exchanges are shut for a week there. It is said that the volumes on the Chinese market have exceeded for the first time 2008 volumes, trillions of yuan traded. There is a sort of a FOMO of getting into stocks again because the markets have been stagnant for a long period of time. A lot of short China hedge fund positions have been wiped out. So there will be a lot of damage on the other side where people have been shorting China and going long the other market. So it is all a play, looks like, of imbalance between the buyers and sellers. And it seems that the current buying is overwhelming the short positions in that market. So this and more in today's daily bite. But let's first see how our markets are panning out. So the discussion will be about the Chinese comeback in the second half. Please subscribe to the channel. Oh, there's a special payday offer on India Top 10. The use code is payday20. There's a discount of 20% and it goes on till 6th of October. Top 10 is essentially a remarkable 10 stock strategy. Picks stocks from the Nifty 50 universe, the strongest 10 stocks every month. There is some rebalance that happens every month. Not necessarily all stocks will change, or not necessarily any stock may not change. And it is designed so that over a period of time, it beats the Nifty by not investing in stocks that are weak in the Nifty. That is the whole premise. Coming back to the daily bite, where are the markets headed? So Nifty completely cracking down today, minus 1.4% on the Nifty, making a high of 26,250 and now already at 25,810. So this rally that started second week of September from nearly 24,800 till 26,200 was quite a remarkable sort of a one-way rally that we had. Only 2-3 days of Fed interest rate cut, dull period in that time. But other than that, it has been a one-way go. So nothing lost really. I mean, we've had a tear of a run, and some give up at some points will naturally happen. So the good thing about today's session, if we see, is that only large caps were really damaged. If I were to look at Nifty Next 50, even that was not, even though being large cap, not so much damage, 0.92%. So just a bit of a give up of the last 6 sessions. And if I see the mid caps, uh, there was hardly any damage. 0.2% is nothing on mid caps. And on the small caps also, all the downside that happened during the day was recovered by the close, actually closing very near the open and closing 0.06% higher. So small caps are giving an indication these current moves in the market are largely FII driven, where the large cap Nifty names are getting slaughtered. And no, I should not say slaughtered because that is a very strong word. There's a mild correction that is happening in Nifty after the run up. Slaughtering would mean 10% cuts in stocks. Bank Nifty, definitely this breakout has failed. So this breakout of the new high that has happened 4 or 5 sessions back, that has failed, minus 1.59% down today. And this rally also was sort of a very unbelievable kind of a 4,500 point rally, of which now couple of thousand points are given up. So Bank Nifty is a bummer in the sense of not sticking and taking support at this point. And let's see where it takes support. Maybe it comes down to the moving average. Maybe it comes down to 51,800. So Bank Nifty is actually the leading cause, I would say, of the markets coming off. Momentum trends, you can see advanced decline towards the declines, but not so bad actually. 28 to 21 is not so bad. But of course, yes, the inclination was towards the declines. The previous session, 27 September numbers or FFIs were not so bad, 1,200 crores sell. But today, I think for 30th September, there may be large numbers, and those numbers are not yet out, and hence I cannot show you right now. But DII numbers were very strong on Friday, and hopefully they will match some of the selling that FIs would have done today. Heat map, entire heat map is red. Reliance giving up big time, 3.2%. Axis Bank, State Bank, HDFC Bank, ICICI Bank, Infosys, Mahindra and Mahindra, Maruti, Bajaj Auto, Hero Moto, Bharti Airtel, Nestle. There was no place to hide. All going down. Metals, JSW Steel, Tata Steel, commodity stocks, Hindalco, all doing all right on the back of the Chinese market going up. Nifty Next 50 also, very strong stocks like Trent, Zomato, Indigo, DLF, all losing ground in a big way. And there was not much of green here as well. But again, Jindal Steel, Vedanta sort of bucked the trend and stayed in flat to mildly positive territory. Uh, Sectoral trends, no sector really was going up except metals. So as I said, metals and commodities bucked the trend. Um, Huge uh, uh, jump in Chinese sectors of metals and commodities there, because suddenly now there is a lot of stimulus in China, and the expectation is that the prices of these commodities will rise, and that is why you see the gains here. And of course, as the metals and commodity prices will rise, autos, real estate, all will get hit because their input costs will go up. And even otherwise, the risk on trades where some gains were made in the previous sessions or last month were the ones where the correction or the profit taking was happening. So nothing much to talk about in terms of any sector. All were down 0 to 2% or so, and pretty much a continuous sort of contiguous down move today. Metals have again come back to their new all-time highs. In fact, metals had been underperforming all this while. It has now come back to its election day high, which for a lot of other sectors was crossed much, much earlier. You can see several metals and commodity stocks are doing well here. Stock spotlight was on Saregama. So this stock is really going up dramatically. This was 480 rupees just last month, and now it is sitting at 631. So a good pattern there on Saregama, and a sort of a breakout and a new all-time high. And it seems like some sort of a flag formation with some support at this trend line has happened. So some strength there in one of the strategies. I think we hold this. The big Chinese comeback is happening in the markets there. So the SSC Composite Index in the last 5 sessions has gone from 2,700 odd to 3,300. So 24% gain in just 9 sessions is an unbelievable kind of a rally for an index, and that too the primary index. So imagine if Nifty goes from 27,000 to 33,000. This is the kind of move that will be there. But of course, Nifty has not been as dull as SSC for the last so many years. Hang Seng also moved 24% in 13 sessions. So stocks or indices which have been languishing for a long period of time are very quick to move when they move, because there is no resistance, not much resistance on the way up until significant first move happens. Because now as the trend starts up, people will start getting these picks in their momentum portfolios, and a lot of you will not believe it, but how many sort of high percentage of people actually are momentum investors. uh, so all those all that money will start kicking in, and the price doesn't stop like that, and it basically creates a complete squeeze on the shorters who have been enjoying the Chinese stock market shorts for such a long period of time. So if in the longer picture, if you see, even after all this rally, we've now come back to 2007 levels. So 14 years of not going anywhere, actually, even after this rise. That is the kind of slump that we've had in the Chinese markets. And of course, if you see uh, the past history from 1990 till 2008, they had a remarkable run. I mean, just see, from 100 to 5,000, 50 times they rose between these 16 years, and then they went flat. So this is exactly the same phenomena that I was talking about some days earlier, that there can come a phase for India also where we go phenomenally well in 5-10 years, and then there is a lull for the next decade. That is always possible, and this Chinese market has shown that actually. Hang Seng also, even despite this 24% rally, is back to 2007 levels only. It is still much lower than its all-time high. So anybody who bought at these highs is still sitting at a loss. Anybody who bought in 99, 2000 right here has mildly gained something in 25 years. That is the kind of patience people have had to keep in these markets. So always remember, index investing is not foolproof, and these markets are showing you that. So you need to have a strategy which may be built on the index, but will have that ability to beat the index in the long term. The issue in China majorly is a real estate issue. You can see how the Chinese markets went up, and then there was a complete collapse in the property sector. The Evergrande, which was the largest real estate company, that collapsed in 21, 22. And the fact is that a lot of Chinese money, household income, household savings was saved into real estate and leveraged real estate. I mean, India is a very different animal, because in India, even if significant amount of household wealth is in real estate, significant part of that is also not the leveraged part. It may be unaccountable money, or it may be already paid off, kind of, because our banks are not so risk takers in terms of real estate loans. So Chinese, the inflation has been coming off since 2021. In fact, it is deflating in the last 5 quarters. So I mean, they were basically pushed against a corner how to save the market. On one hand, your saving is trapped in real estate. The real estate prices are coming down. So everything is coming down, cooling off. Metals are down, commodities are down, jobs are getting lost. And they basically were put into a corner how to get out of that. So they essentially decided to take this risk of aggressively giving stimulus to the economy. It still does not mean that the Chinese market can come out of this without recession. It may or may not. Nobody really can say. But the situation was really, really bad, and that is why the markets have been so dull all these years. Uh, Foreigners have been selling out of China, and only now some hedge funds, etc., may be coming in. It is not that it is a limitless rally that has started. Maybe it is a flash in the pan. 20, 15, 20 days later, maybe nobody talks about China again. So all this basically has happened largely due to the real estate concentration. So the stimulus package, the Chinese government has cut reserve requirements by 0.5%. They have cut the repo rate. They've lowered mortgage rates. They've injected money into the banks. They've forced the banks to reduce home loans. So they're trying everything to perk up the economy in some way or the other. The GDP has been falling quite dramatically, and the fact is that these measures may still not be enough for them to come out of their current recessionary point of situation. So too early to celebrate that everything is gung ho in the world. If this stops and starts going down, we will see again metals and commodities kind of move down. So how does it impact India? uh, it will definitely impact foreign fund flows in the short term, because if a market which is one third the valuation of India is doing all right in terms of a timing of the trend, a lot of funds may hot money may go there instead of coming here. um, and of course, all this rise of commodities and metals may harm our manufacturing to that extent. Um, and it is really difficult to say, what kind of impact of what earlier we were talking about China plus one. Now it seems it will become China minus one kind of situation that is happening. So we probably weren't able to really capitalize on that period that we had where China was in a doldrum. And I think that India has missed that bus largely. We can keep shouting from the rooftops that we are becoming a manufacturing hub of the world, but we are still at 3% of world's manufacturing, and China is at some 31%. So even in this lull, they have grown their manufacturing from 25% world share to 31%. We've gone from 2.4 4% to 3%, something like that. So we have a long way to go. So, but we are continuing at our pace. I don't think any dramatic change can happen here. We are certainly, from all metrics, a highly valued market now. Um, as long as liquidity flows towards our market, we are doing all right. If liquidity stops, we are in trouble. That is for sure. So the idea is that there should not be unbridled optimism just because we've seen some great months in the past. So always have your risk goggles onto your strategies, onto your portfolios, have asset allocation, um, because you don't know how the world is going to be. Just today's snapshot tells you how messed up the world is. Japan was down 5%, China was up 8%, India was down 1.5%, and we don't know where the US will go. And the dollar index is right at 100, willing to break down. So let's see if the dollar index breaks down below 100. I think emerging markets may still get some tailwind to go forward. Let me know your thoughts. Thanks you. Bye bye.